Hello, and welcome to another episode of Connecting Climate Capital. Today, we're delighted to feature the really global and impressive portfolio of FS Impact Finance with their Senior Investment Manager, Derek Campbell. We come together and convene global thought leaders, actors, decision makers who are active in the space with one collective goal. We are looking for new solutions, new approaches, new tools in the toolkit to overcome the global climate financing gap. There'll be a lot ahead in the next 2 weeks as we approach COP, and COP season is really one of the hot spots in the year of activity around this. And as a lead up, again, we're looking forward to getting Derek's take on these questions. To break it down and to provide some preface for those who are getting their feet wet in the world of climate financing, a couple notes. First, what do we mean by this? It can be local, it can be national or transnational type of financing mechanisms. And this can be drawn from public, private, or alternative sources of financing. It can be on the mitigation side, thinking about how do we avoid more emissions. It can be on the adaptation or resilience side. How do we deal with the climate shocks and consequences already in place? We do see tremendous growth in this area. Climate finance is picking up in the billions and the hundreds of billions year over year. But we're going to need to get to trillions of financing to maintain the cogency of the 1.5 degrees Celsius pathway. That is science aligned, that is Paris aligned, and that is a collective goal of so many working every day on these questions. Again, just for a reference point, as a bit of context to Derek's discussion, on the private side, it's about half of climate finance comes from the private side, about half from public. Again, these are interesting reference points and indicators of where trend lines are going. Again, a lot of this will be broken down, but this is a split, and you see it across debt, equity, and grants. Finally, another sort of context-orienting slide, breaking down this even further. Who are the public financing actors? Who are the private financing actors and the financial instruments that you might hear about in today's conversation? Again, we think about at the national level, we think about at the multilateral and multinational level. Governments and their departments and agencies and ministries are all part of the equation. State-owned enterprises, we're seeing a lot of interesting activity on the infrastructure side, green banks, sovereign wealth funds, the list goes on. On the private side, you have large corporations, multinationals being quite active, picking up a lot of steam, households, individuals, commercial finance institutes, institutional investors, infrastructure funds. Again, there's so many actors in the space, and then they can come together in new and novel ways with a different set of instruments, tools in the toolkits that will go in deeper during the discussion. But again, for a shared vernacular, grants, different types of guarantees depending on the size of the deal and type of project in place, tax credits, carbon taxes, carbon credits. Again, we could spend many episodes just on that topic alone. It's quite a burgeoning field. And then there's a lot of discussion, as you'll hear, on concessional loans, concessional financing, first loss financing, and again, also on the blended side. So just a bit of reference point for those who are getting their feet wet in the world of climate financing. What it comes down to is back to my first question, how do we mitigate the global financing gap? Well, it's to build this connective tissue between the investors and the recipients. When we talk to investors, they say, look, there's no pipeline, there are no investable projects. When we talk to recipients, they say, look, there's no money. And we think there's some truth on both sides, but more than anything, what we feel like is we need more overlap and more mechanisms by which these two sort of pools, although it's not a binary, are better connected. Just to sort of step back and take a look at Telesto, our involvement in convening, bringing together decision makers, trying to push technical boundaries, explore new solutions. Our journey started a couple years back now with sort of a tech convening in San Francisco, getting involved and hosting an official White House side event at the US Africa Leaders Summit to think about a curated engagement for those decision makers around climate capital between US and Africa. continuing that thread in Accra, and different delegation that thinking about how do public sector climate finance get to the destinations that can lead to most impact on the ground in Ghana, which led to, again, these convenings that we do virtually to spotlight those working on novel solutions, to our own then accelerator program in Ghana, where we focus on climate tech on the ground. Next month, we'll be at COP shortly. We look forward to seeing you all there. And in the years to come, more of our accelerator activity and more tailored convenings. With that, briefly before I hand it over, what we do at Telesto, we believe that a good business strategy and organizational strategy needs to be integrated with ESG and sustainability. We see it as a business opportunity and a business imperative. To accomplish these things, we help companies, investors, organizations get started with ESG. We equip their leadership. We explore these new financing mechanisms around climate finance, as we explored. The heart of the Paris goals is the road to net zero. And we do help with that. Like I said, we integrate the strategy with sustainability, and what we can't improve, or we can't measure what we can improve, and we need data at the core of what we're doing. So we also help our partners with that. So with that, I'll hand it over to my colleague, Andrew Allisbury, a managing director at Telesto, and he'll lead the conversation. Thank you.
Thank you, Alex. So our speaker today, we're very privileged to have Derek Campbell, who is a senior investment manager at FS Impact Finance with us today. And he will, through the course of this conversation, be able to give us a very important and interesting perspective on the world of climate finance as it pertains to renewables and technology in that space, especially in the developing world. So without further ado, welcome, Derek. Thanks for joining us. Just to get us started, Derek, I wanted to ask if you could first just tell us what is FS Impact Finance and what is it that you all do?
Yeah, thanks a lot for that, Andrew. Yeah, so FS Impact Finance is a German licensed fund manager who's been around, I guess, for nearly 2 decades now. Started out kind of actually in a bit of a weird circumstance where we have a sister company that does consulting work for a lot of the big development finance institutions, governments, and from one of those mandates, we were asked to run a fund, which kind of then made them scratch heads a bit and say we're not equipped to do that. And then we had to go set up a fund management business. So that started, 18 years ago. To date, we've deployed over 700 million euros into emerging markets, primarily in the microfinance space. And in the last decade, including renewable energy, and then more recently also deploying capital into the forest and landscape restoration sectors across essentially Africa, Asia, Latin America. So we headquarter out of Frankfurt, have teams sitting around the world, kind of in certain strategic locations. And I mean, that's, I guess, the crux of the business to date.
Great. So how, Derek, did you come to sort of be at FS Impact Finance for as long as you have been? What's the journey that brought you there?
Yeah. So, I mean, it actually, it started, I've been here now 7 years. Prior to that, I was sitting in South Africa's IPP office doing the small scale renewable energy auctions. And through that work, got to work a bit with KfW, the German Development Bank, on providing some inputs to setting up a debt fund in the renewable sector in South Africa. Got to know the KfW team a bit, who then also had very close relationships with my initial boss at FS, and got together with her on a spring afternoon in Cape Town. We got on well, and next thing I knew, I was Googling, or I'd agreed to move to Frankfurt, and then I started Googling a bit more about Frankfurt. Didn't really get the weather right, but giving up South African supposed winters for now snow on the ground in November. But it's been a great journey. Been able to go to a lot of different markets and had some really great experiences doing so.
Great to hear. So you a little bit got into it when you were talking about what it is that FS Impact Finance does, some of the motivation for why it came to be. But just to be more explicit about it, can you sort of tell us about what is the investment approach that FS Impact Finance takes, and how is that unique?
Yeah, so I think one of the interesting things here is we sit on within FS Impact Finance, we have two very different spectrums. We have a couple of different strategies. The main ones in the microfinance side, which is on behalf of a private German bank, where we manage about 250 million euros of funds. And then on the complete opposite end of the spectrum, we deploy around 60, 70 million euros on behalf of a couple of different government actors into early stage renewables and forestry assets across the global south, really. So yeah, I mean, we represent two very different actors, kind of trying to provide tailor-made solutions to fit problems that exist in the market. So kind of just trying to piece market issues with the right investors is kind of one of the key pieces which we look to do.
And so how do you prioritize your investments? I don't know if there are different approaches for the two different funds, but can you just tell us a little bit about how you think about where to put the funding that you do?
Yeah, so I mean, these are all separate strategies which we manage and separate pools of capital that go into it. So within, I mean, the microfinance fund has a very specific mandate for microfinance institutions on a global basis, where we feel there's a very strong and compelling underlying social impact. On the renewables side, we're looking really across Southeast Asia and Africa for what we see as strong development partners who we work with and partner with to really take alongside them early stage project risk, while at the same time ensuring that they're scaling as a company. And within the forestry space, we're working predominantly with private equity funds who are either setting up new funds or already deploying funds into the sector. So it's quite a spectrum of different actors we get to work with, which also makes the day-to-day quite fun and interesting.
Yeah, I can imagine. And so you talked a little bit about the sources of funding for these funds. In terms of raising, I mean, are you sort of proactively seeking out growth year over year from your funders, or is this something that they kind of willingly give to you on an annual basis? Just can you tell us a bit more about what it's like to go out and seek funding for these kinds of projects?
Yeah, so I guess it's also a bit strategy dependent in a sense. So for the seed capital strategies which we manage in the renewables and forestry sectors, we have committed capital there which we don't have to actively raise for. So we have a certain bucket of funding which we can deploy over a 5-6 year period, which makes that easier, and rather trying to go to the markets every year, and especially in these current prevailing market conditions, I don't think anyone really wants to be out there, unfortunately, but it's part of the business. On the microfinance side, it's a bit more nuanced, as we have a German private bank who essentially distributes the fund offerings to their clientele and their clients. So a couple of different angles. I mean, we are looking at a couple of new options and strategies around fundraising for new strategies, which will involve kind of really going to the market but more trying to find more capital solutions that are going to be there for the longer term and not trying to continuously fundraise, which takes a lot of energy, cost, and yeah, it's in this market very difficult to try compete with 5% US treasuries.
That's right. Why bother investing in renewable projects in the global south when you could just put it in a treasury bond?
Yeah, no, exactly. And that's kind of, I think, what a lot of people are going through at the moment in terms of fundraising is this. I think there's this expectation that you can get 15-20% in these emerging markets in infrastructure assets, which isn't really the case. So how then it becomes a bit of a different discussion as to how you kind of figure out how to try increase your yields on projects, kind of getting to scale more efficiently, to try compete with something that's in theory is risk-free. I mean, we'll see in the medium term whether that is a risk-free bet.
That's right. Don't hold your breath until 2024. We'll find out if that's true. Okay, well, that's great. Thanks for that context, Sarah. I'd like to deep dive a bit into one of the facilities you mentioned, which is the Seed Capital Assistance Facility, which you oversee, and as I understand it, has a bit of a renewable energy focus to it. Can you tell us sort of what kinds of investments this facility prioritizes, both in terms of stage, but also sort of projected return profile? I take it, topically speaking, it's renewable energy, but there are many different subcomponents to renewable energy. Just give us a lay of the land, please, of what this facility is all about.
Yeah, so I mean, actually, I'll start with a bit of the backstory to it. Was actually when it was set up originally, it was actually really focused on trying to move private equity capital from PE funds into earlier stage renewable energy development. And because, as you know, when you go to all these conferences, everyone says pipeline, pipeline, pipeline. So that was the initial, what I would call a SCAF1, which was set up, 2012, 2013. And it worked with kind of the first PE funds in the renewables markets across Africa and Asia, trying to take risks alongside the funds to actually, deploy capital at an earlier stage across technology agnostic. I mean, there's going to be solar, wind, run-of-river hydro, kind of we would be willing to do everything. And one of the things we found as we went through it was the pipeline question was still continuously coming up. We went through a bit of an iteration, 2015, 2016, where we more honed in, or not only honed in, we expanded to work more with developers. So just your bread and butter renewable energy developers, who are the ones kind of running from office to office in emerging markets, doing all the studies, getting all the stakeholders together, trying to get utilities, ministries of finance. So we actually started working with them more, or for the first time, and that's actually worked out really well, where we're now looking, or predominantly actually portfolio consists of renewable energy developers across Southeast Asia and Africa, who we can kind of, I guess, one of the things we've been able to do and reach a good scale. And I think to date we've funded over 2 gigawatts of pipeline across renewables. Those are kind of coming to fruition now and reaching financial close and operations. And we really focus on, I guess, 2 parts to this. One is really on the company and corporate level, helping them scale internally, boots on the ground, new hires, key hires entering new markets, and then at the same time working with them to take pretty early stage pipelines of projects and actually finance them, co-finance them through to financial close, which we then is kind of where we exit. And usually for developers, they've also exited historically. So that's kind of the modus operandi. Is sometimes these projects get exited to other equity investors earlier on, and the sales take place, which is also fine by us in that sense. So that's, I guess, strategically where we sit at the moment, and probably would look to continue to do so. On that side, I mean, this is a UK and German government funded facility, and our implicit target is just ensuring capital is returned at the base on basically it's an unsecuritized 1x, so it's just money back, recycle it, redeploy it, and reach as much scale as possible on that side.
And what is the typical ticket size of the kinds of investments that are in this facility?
It's ranges. Over the years, we've seen costs go up significantly. So I think kind of when we projected at the start 2016, we were looking, dev costs were sub 1 million. Now, if you can do a wind farm through lenders DD for 2.5 million, you're doing a good job. That's kind of just the way the market's evolved. So we can kind of always look to fund 50% of the costs related to these developments of these projects. We can range, from small scale projects of, kind of the 5 megawatt range. We've also done 100 megawatt, 120 megawatt wind farms. So it really depends. Sometimes we get involved later on to kind of more act as a troubleshooting provider in terms of capital solutions, if we have comfort that the projects are sufficiently progressed that we have a good line of sight to financial close, and kind of if something has gone wrong and they need additional capital resources, we can step in then as well. But then it's kind of really making sure that we will have a high degree of certainty, which in these markets is maybe not always the usual, but have at least a relative comfort to take that risk to deploy their capital in.
Okay. And you've talked at least implicitly a little bit about some of your ROI, looking for the returns. You said recycled capital. I also heard you talk about installed gigawatts. I was wondering if there are other sort of metrics you looked at when you considered what is good value for money when it comes to investing in this space.
Yeah, so I think, just because we've been funded by the governments, we also have a bit of a mandate to take frontier market risk. So we do look at it slightly differently. We won't do the 20th small hydro project in Uganda or the 10th or 15th wind farm in Vietnam. We do kind of take a bit more of an approach where we're also there to unlock markets So we are willing to be the first into new markets to try to do that. Recently, one of the projects we financed in Zimbabwe alongside BS Hydro reached financial close. Is probably the first project finance transaction in Zimbabwe in quite a few years, given some of the issues they've had. I mean, it took 10, 11 years to develop this project, but it did get there. So we are also looking at new markets all the time, but there is also, we always try to go where the private sector leads us and where developers and funds are willing to go.
But that sounds quite difficult, right? Balancing, oh, we want to create a market, but be led by the private sector. It sounds like a bit of a catch-22 or a chicken and an egg problem here.
Well,
what does one do with that?
Well, developers, and especially in renewable energy developers, they're very adventurous by nature. So we get, I mean, we've seen kind of projects across all the markets. They're always looking for new markets kind of to get that entrance. Also for them, I think when you can kind of unlock a new market, you get, I guess, a strategic position in that market. And we've seen that historically with the likes JC and Capital. When they went into Malawi, they got a few projects across the line there. They've got a strategic position there, which creates not a moat, because you're never going to have that completely, but you kind of get a good market position, understanding how to work in these markets. So there are these types of examples where definitely, yeah, I mean, the private sector and going back to developers, they'll go where they believe they can execute. And they are, in general, some of the most optimistic people you will be, because I think you have to be in these markets, and there is a certain risk you have to take, unless you have a lower cost of capital and something that's not completely at risk.
And does your conception of ROI, does it include sort of sustainability metrics? Does it include ESG style metrics, or sort of job creation and economic development metrics?
Yeah, so I think, I mean, all the developers and projects that we work with, they need to be developed to a certain standard. And that's on the ESG side. If you want any international financier, you need to have IFC performance standards embedded in your ESG work that you do. I mean, our primary objective here is around clean energy and megawatts. That's step one. It does then, you do obviously get the trickle down of job creation that comes with it. But our pure focus, or our main focus at least, is going to be on renewable energy projects closing in new markets. That's really for us kind of the cornerstone of what the program has been anchored around, also when moving capital to such an early stage, as to kind of the main key indicators and on the KPI side. But we do track a litany of them, which I'm sure some of our partners find annoying to do at times in the reporting, but that's what the money comes with.
Yeah, strings attached. Okay. And you talked about risks a bit. How do you hedge against risks? I mean, it sounds like you're really trying. I accept that there's always going to be some level of risk inherent in investments, maybe even including U.S. Treasury bonds, as it turns out. But how do you hedge against sort of in frontier markets, in renewable energy space, which is considered by some a more adventurous investment space? How do you hedge against the various different risks that are there? And maybe to make this more concrete, you can talk about potentially, I like the Zimbabwe example you brought up, because I think that's probably an especially risky situation. Maybe you can use that as a little hypothetical sandbox for how you would walk in through an entire deal and try to hedge against risks.
Yeah, I mean, each market is so nuanced, and the reality is it's complicated. That's just, the easy answer. The more nuanced one, there's the currency issue. How do you deal with some of these markets? A lot of developers and investors, they're looking for USD denominated tariffs. That's becoming increasingly difficult to find, especially in Africa and Asia. They're at comfort to take local currency tariffs. In Africa, maybe outside South Africa and one or two other markets, they want US dollar tariffs, which, given the countries and their forex situations, has become increasingly difficult on that side. And then the convertibility issue. And so the currency topic is continuing to be like number one on the list of issues. And I mean, there's been solutions in other sectors for some of the debt investors across emerging markets with hedging instruments, which they can use, which has done a lot to unlock financing on renewables. It's a bit more difficult. I mean, so a lot of people still try to go the USD route, but yeah, it's probably coming to an end. So I think one of the better ways to go about it is actually bringing in also local investors, local financiers where possible. This did take place in Zimbabwe. They've actually came up with a very unique structure on that side. We've also seen solutions like in Nigeria, for example, through PIDGE and the UK broader group there, where they set up InfraCredit, where they're using guarantees to unlock local capital to provide debt to projects. So there are these solutions that are becoming more and more mainstream in that sense, and will continue to be. I guess the balance there is, how do you still bring in international capital with local currency solutions? That's maybe a bit more of a challenge and needs a bit more ironing out. I mean, you're then dealing with a lot of the political risk or assumed political risk in some of these markets. I mean, there are good insurance solutions around some of these things, where there's going to be your MEGA type or MEGA. You've got regional liquidity support facility from ATI providing certainty on payments. So there are solutions out there. It's just trying to find, I think, the most efficient, and through all the legal agreements, allocating the risk in the best way possible as to who's best suited to deal with it. But it does unfortunately take a lot of work to try to get this all lined up. I mean, these are kind of, I think, the two headline risks that continue to dominate. I mean, there's the ENS risk side, which is more manageable to an extent, assuming you do the work properly and kind of go through and really follow the processes and try avoid some of the more tricky things around land resettlements and these types of issues that do come up. But I think these are things that you can manage proactively versus some of the currency and political issues, which are unfortunately sometimes out of your hands.
But relative to, say, 5 years ago, do you get the impression like there are more third-party actors who are providing sort of hedges against these kinds of prevailing too big risks that you mentioned? Are we headed, globally speaking, in a more positive direction in terms of making these deals easier to put together?
I think it's actually more investors are becoming more comfortable with some of these risks, maybe compared to 5 years ago. I don't know if this toolkit of solutions has increased per se, but I think investors are more finding ways and means to manage these risks and also become more comfortable. A lot of it, when you think of it, is around perceived risks, which is actually a lot higher than the actual risks associated with some of these markets. But some of these markets, there is a level of risk which is really difficult to put private capital into. But a lot of them, in terms of track record, it's actually not as bad as people perceive it to be. And I think it takes kind of one bad headline. I think one bad headline in Africa versus one bad headline in an African country versus one bad headline in the US, you have a very different reaction.
Very different, I can imagine.
Yeah. So I think that's kind of also a bit of the issue, is just that perception that lingers from, decades.
Do you have any hypotheses around what has contributed to the perception sort of becoming more in line with reality?
Well, I think a lot of people, I mean, it's always just being kind of paint a lot of these markets with one brush. And even, I mean, I've had instances where on fundraising calls with investors, they say, what you're looking at, and you say to them Africa, but they then, and which consists of over 50 countries, and then they'll then ask, but what's your diversification strategy? So what happens in Kenya to Zimbabwe, there's no correlation, similarly to South Africa to Nigeria. So I think it's for some other reason this perception exists. And I think it's also one thing, I mean, the market can also do some favors for itself, I think, from time to time, especially the governments. They maybe don't do themselves favors, with South Africa changing finance ministers over a weekend, what that did to the rand. We've seen more recently some issues around Kenya, Zambia, and the IMF creeping up. And so I think the governments can probably help themselves a lot just by avoiding some of these things. But I guess that's out of our control, and it's I think also will help the market is continue to just show continued success. And that's, I think, one of the keys, even when you look at the capital going into renewables in Southeast Asia versus Africa. Southeast Asia has this continued traction that where you've had Vietnam and the Philippines, they've continuously been procuring, and Philippines is only more recent, but continuously procuring renewables. That kind of de-risks it and gets the market settled, versus some countries will put out a tender for a couple of 100 megawatts and then they decide to cancel it after 2 years. And people have spent a lot of money to kind of get projects ready to submit, and then you're left holding the bag. So it's these types of things, I think, which I think the government can also help bring investors in with kind of, a bit more of a coherent strategy at times.
Yeah, that makes a lot of sense. So over the sort of 7 years that you've been doing with FS Impact Finance, what are some of the hardest lessons that you've learned about this space in particular, but maybe impact investing more generally?
Oh, I think when it comes to this space, I think kind of one of the key pieces we've seen, and this kind of goes back to what I just said as well, is, I mean, you kind of sometimes will get the impression that transactions are just about to close, projects are just about to close, everything's getting lined up, everything's happy, and there's a lot of confidence in it, you're really spending the money kind of going through all the closing, and then something can change over a weekend and 5, 6, 10 years of work and millions of dollars can disappear. That has happened in the past. I think that's always, I guess, always going to be hard to deal with. It is a risk that does take place. I mean, we have seen these things happen across multiple markets, and even it's not only an emerging market problem. I think there is a lot. I think the key thing as an investor in these markets to actually have is just kind of the patience, and also having patience is definitely number one. I think there's also the key part which we've seen, which has always been successful, is really building a partnership model and really engaging with all the stakeholders on an equal footing. That's, I think, is also kind of been one of the key, and that's when you're starting to deploy boots on the ground who are there consistently interacting with different stakeholders. So I think, while you sometimes can disappear, but at the same time, they usually don't disappear for good. It's just kind of maintaining those stakeholder relationships, having that patience for these transactions to develop, and sometimes they kind of get put on the side to simmer, but then they can also reach boiling points again and kind of become something that's fully baked. I mean, each market's nuanced, and you have to treat each one in a very separate level and how you deal with it and the stakeholders within it.
I just wanted to ask a follow-up question on one of the things that you did say about getting all the stakeholders together and treating them on equal footing. I mean, what does that look like in practice for an investment deal?
I think it's really, I think one of the keys here is like really treating this as a very long-term partnership. And I think really trying to be focusing on a collaborative effort, to get a renewable energy project to financial close, there's a lot of different stakeholders within, a lot of different, whether it's government entities, regulators, landowners, and kind of just really focusing on a collaborative effort to do it. And there is a lot of sometimes just simple coordination that sometimes is missing, and something gets misinterpreted, and then you're kind of on the back foot. So it's really trying to also bring them in as ensuring that they are really feeling part of this and their input is also valued. I think a lot, maybe not as much today, but in the earlier days, people would kind of jet in for a week, demand meetings with X, Y, and Z, disappear again for 3 months. That's not how these partnerships should work. And you're probably also not going to be in favor with the governments when doing it in that way. So I think it's something that's like any relationship, it's going to take time to develop, and you have to put that effort in. It's not going to just magically appear one day and you have a big project. So it's really that time on the ground, time with them, even using the time to work through project documents and agreements with them from a very early stage. Don't go to them deep down the road with legal agreements written up by lawyers, which can sometimes get overly complex at times. So it's really bringing them along for the journey, I think, and that's kind of just spending that time with them to do that.
I imagine that it varies on a deal by deal basis, but the responsibility or the role of being that glue or that coordinator that brings people together and ensures that there are these relationships and partnerships built up, does that fall to somebody like yourself or somebody who works at FS Impact Finance, or does that fall to the government if it's involved in the deal? Who's
I
sort
mean,
of in charge of that?
at the end of the day, it has to be the project developer themselves, the kind of the main promoter of whatever it is, to kind of really be that string puller to kind of pull everything together. They need to be the one who are with every whatever government ministry it requires, whether it's going to be the environment, finance, natural resources. I mean, take your pick of a government entity that could be involved, and you really need to be trying to convene and build those relationships. And that's kind of what, well, outside of going and sourcing good renewable energy sites, that's one of the key parts of the project developers, just a pure play project management of all these stakeholders and that stakeholder engagement.
And so as an investor, I take it you look for people with track records of doing this when you're looking for project developers.
Yeah, I mean, it's kind of, I think when we look at the team, you want to see teams who have been able to deliver in these markets and or in adjacent markets at least, and just have that track record of being able to do it. I think the road to financial close of projects in Africa and some parts of Southeast Asia versus Europe, it's not a straight road. It can be a very windy road. So you need to kind of have someone who's been there and done it before. It's very difficult to parachute into a new market and kind of pick it up. Whereas maybe in Europe or the US, you know that to reach financial close, you need to do X, Y, and Z. But sometimes you might need to, in some of these markets, go from X to A and then back again. But it's just, so it's really someone who has that ability to do that as well. And it takes, I think, also, when I said earlier, renewable energy developers full of optimism, they're also very good in that sense, and they've kind of got, or hopefully have an acute understanding of how to do that properly.
And is the availability of renewable energy project developers, are they becoming increasingly local, or are there still a lot of sort of foreign players that are doing a lot of this work, both in Africa, but also in Southeast Asia and any other geographies that you work with?
I think it's, yeah, I mean, you get a bit of a mixture. I mean, the best teams out there have, I guess, I mean, what we see at the moment is local expertise embedded nowadays. You need to have, I think also, especially across these markets, and each one is so nuanced. I mean, even from the way you negotiate in Cameroon versus Ethiopia, for example, it's going to be very different how you actually sit at a table and negotiate. So you need to have that local, or really need that local team to develop and drive these relationships and projects. You do still find teams who have international players involved or international teams, but more and more you're seeing kind of the wheelhouse of the team is predominantly local. And that's just because you need it in these markets. I don't think if I had to go sit in a minister's office in Nigeria or somewhere, it would be very different than for a local person to go be able to do that.
Yeah. So changing tracks just a little bit here, and since you do sort of have this strong technical background in renewable energy, what are some of the new and exciting emerging technologies and trends in renewable energy these days?
Yeah, so I think, I mean, the thing that I think is getting a lot of attention now, obviously, just based on due to costs and what it does in terms of the grid side, is obviously the storage side. But what's even more interesting is we've seen some larger and larger hybrid projects. So you're looking at combining PV, wind, and batteries that really kind of smooth out some of the intermittency issues. They are from, I mean, you have to get those locations from a site perspective is somewhat difficult. But those types of solutions, I think, will really become going forward a bit more just standard and part of it. You're not going to have a standalone PV plant by itself, unless, depending on, especially I think more so in the African market and understanding how the power grid looks, very difficult to just have a standalone PV without adding battery solutions to it, just because of the intermittency and some of the issues around that. So I think it's going to be, I mean, the scale up of the storage side, and then larger PV projects, maybe to actually add more storage capacity, feed in during intermittency time, I think will become just the norm going forward. And then some of these co-located sites, we're financing a couple of hybrid projects across Africa and Asia, which if getting to close will be very exciting to see, just given some of the nuances behind setting up such a project. To kind of started, I guess, the first to do some of these hybrid projects was WindLab in Australia. We busy financing through Cerity Green, which is was a WindLab company, a project similarly in Kenya, which, yeah, it's very interesting from not only the technical solution side at Meru County Energy Park, but also even taking a bit more of a more interesting approach, kind of how they're structuring it in terms of ownership, bringing in different parties and local parties. So that's something that we expect will probably continue going forward. Also, I think those will be probably the main two in the next 3 years, where it becomes more the norm than the rarity.
With this additional sophistication of the technical solution, does this make the job of creating a deal more difficult as well, or are we similar amount of effort but for more technically interesting outcomes?
It probably does make it more difficult, because I think just the legal agreements will have to change quite a bit to factor some of these solutions in. In the past, renewables usually was just kind of a straight take or pay agreement. Now, if you're adding storage solutions and how that feeds in, when it feeds into the grid, under what tariff structure, there are some of these nuances which will need to be built in. Sometimes some of the storage projects can be used not only for feeding in power, but for more regulating grid frequency. How does that get structured? So there are some of these pieces which will add complexity, and a bit will also require a lot more modeling in terms of the energy perspective, right? So just understanding how you're shifting the load, what you're doing to the overall grid stability with such projects. The benefit will be there, but it's also you then need to really spend a bit more time on energy yield modeling and forecasting what the impacts will be. But then I think the overall net benefit to the grid and its customers at the end of the day will be there.
Yeah. And are you seeing sort of any deployment of more frontier type technologies in the renewable space, or is it predominantly sort of wind and PV, as you were alluding to?
Yeah, I mean, it's predominantly wind and PV. I think, I'm not sure in terms of new technology. I mean, you'll find new modules coming out with high efficiency ratings, these types of things. I mean, where it goes, rewind 10 years and everyone thought that CS concentrated solar power was really going to be at the forefront. Well, that barely exists anymore. It's really just become mainstream solar PV that's kind of took off. I remember in South Africa's first auction, solar PV was more expensive than CSP. But now looking back at it is, yeah, good for those initial solar PV bidders. They've done very well for themselves, but at the time it was considered a high risk technology, whereas now, yeah, the game's changed completely. And kind of PV, yeah, it's going to cover a lot of acres of the planet.
Yeah, also pretty hard to predict these things 10 years out. Well, I was going to ask then, what should we expect to see from FS Impact Finance in, say, 5 to 10 years? But why don't we pick a more predictable time frame? What are you excited about that you all are doing over the next 1 to 3 years?
Yeah, so we've got a couple of new strategies under development. We're kind of looking at some of the models and strategies we are using at the moment and how to change and tweak them, and maybe look at bringing in new source of capital. I think we are going to always probably be more focused, well, not always, but still focused on some more niche areas. Kind of, we like this area within SCAF and how it operates at the moment. And so one of the questions we've been asking ourselves, what do we do to really bring in more institutional capital into this space? Because I think one of the key things in these markets is that we need to figure out how to shift money earlier on, and that money also it cannot always come from DFIs and governments. It needs to come from a private capital base. So how to do that and be able to do it at scale. I think, one of the things that will always impinge projects in these countries is the lack of capital for earlier stage renewables development. So we are looking at some kind of things and models that we can use to bring in more capital. How do we de-risk private capital sufficiently. We are looking at some other sectors as well, which are kind of on the fringe at the moment, I guess, but they are getting attention. I think it's really being able to, when looking at these, thinking what solution makes sense and to who. And that's really kind of how we're kind of looking at it. I think we're working on something. I can't say anything just yet. It's in a different sector that hasn't really been invested in much before. And sometimes we've tried some of these things in the past, and the investor appetite for new things is also quite difficult to move at times, especially new things, new markets. It can be a difficult sell. So it's kind of, well, how do you shift them, not maybe 180 degrees, but start shifting them at 10, 20 degrees at a time. So it's probably more in terms of approach-wise as well, what we're thinking about as well, not taking them too far too soon.
Great to hear. Last question, Derek, for all of our aspiring renewable energy project developers who might want to be looking for finance in the Global South, how can they get in touch with you?
So I think the best part for them to start is to go look at a SCAF website, so SCAF Energy, that kind of has basically everything on that side, and kind of understand what we're looking for, what type of partners we're looking to partner with, what we do actually. So I think that's probably the best starting point, is go to this, or scaf-energy.org. That has, and it will tell you a lot more about the projects we have financed historically as well. Some of what I'd like to see, believe, are lighthouse projects in some interesting markets, and also see what we can do for them.
Great. Well, thank you so much for your time, Derek, and for your very candid and honest answers. We always appreciate having people with deep expertise such as you have, and we really appreciate your coming on the show.
Yeah, thanks a lot for having me, Andrew. Absolute pleasure. Always good to talk about these markets and the exciting things that do come with them.
Looking forward to seeing more of it in the future. Thanks again, Derek.
Thanks, Andrew.